I welcome you to a discussion on Biocon's Q3 FY24 earnings. And I'm pleased to present to you a very comprehensive overview of our recent business performance as well as strategic initiatives. In terms of our consolidated financial performance, Biocon has reported a consolidated revenue of 4,519 crores, which is 50% greater than the same quarter last year. Biosimilars grew 65% year on year. Research services was up 9%, and generics delivered a 4% sequential revenue growth, but had a muted quarter on account of continued pricing pressure in the markets that they serve. In terms of group revenue from operations, this rose 34% year on year to 3,594 crores. I must emphasize here, though, that the quarter's top line was supported by income from the divestiture of two non-core business assets of Biocon Biologics, branded formulations business in India, which amounted to rupees 350 crores, as well as a gain of rupees 456 crores from Biocon's stake dilution in Bicara Therapeutics. Core EBITDA for the quarter stood at 983 crores, reflecting a group core operating margin of 27%. I would like to explain that core EBITDA excludes the impact of the asset sale in Biocon Biologics, as well as the gain from Bicara and our R&D expenses. Biocon's R&D expense is industry-leading. This is on account of the biosimilars business, which is a very R&D intensive business. And net R&D investments for the quarter were rupees 329 crores, representing 11% of revenues ex-Syngene. Group EBITDA for the quarter, which included the benefits of the asset sale and Bicara, stake sale dilution gains, was up 106% at 1,492 crores versus 723 crores last year, with an EBITDA margin of 33%. Depreciation, amortization, and interest increased by 260 crores this fiscal over last year, primarily related to the biosimilars acquisition cost. Profit before tax and exceptional items for the quarter stood at 787 crores, which is up 220% from 246 crores the previous fiscal. We recorded a net exceptional gain during the quarter of 16 crores net of tax and minority interest. Consequently, net profit after exceptional items stood at 660 crores as compared to a net loss of 42 crores the previous fiscal. Now, coming to highlights, I'd like to start with the strong performance that our biosimilars business at BBL delivered. Biocon Biologics Q3 revenue increased 65% on a year-on-year basis and 26% on a sequential basis to 2,483 crores. Excluding income from the divestiture of two non-core branded formulations India business assets, the sequential growth stood at 8%. This translated to a core EBITDA of 587 crores with margins at 28%. Adjusting for a series of integration-related expenses and one-off costs, our core EBITDA margins would have been 5% higher, in line with our mid-30s guidance. EBITDA margin for the quarter was 29%, with R&D investments at 11% of revenue. Profit before tax stood at 196 crores. Revenue growth for the quarter was driven by continued robust demand for our products, as well as increased market shares across our geographies. What I'd really like to emphasize in this quarter's briefings is the very strong and successful integration that we've had in terms of our acquisition. The strong Q3 financial performance actually demonstrates our ability to maintain growth momentum while executing on a complex and accelerated integration of the acquired business. We concluded the integration of the entire acquired business 1 year ahead of plan, while preserving value, ensuring business continuity, and maintaining a seamless experience for patients, customers, and partners. This, I believe, is important to call out, given the fact that the transition and integration of the acquired business occurred across 120 countries worldwide. The execution was planned meticulously to ensure seamless business continuity and smooth people onboarding. At the same time, there was a complex digital integration, which also was handled extremely deftly, and we continue to win regulatory approvals in various jurisdictions and secure new customers and tenders, both in advanced and emerging markets. I do believe that the successful transition and integration is a critical milestone in our journey. We have now truly transformed ourselves as a globally scaled and vertically integrated lab-to-market biosimilars enterprise. Now coming to debt reduction. Debt reduction and strengthening of the balance sheet remains a continued focus for the company, and we are pleased to report that during the quarter, we received 220 million from an existing contractual receivable arrangement, 200 million of which were used to reduce our acquisition-related debt. With this paydown, the net debt to Biocon Biologics, excluding structured financing instruments, came down to 1.2 billion. Overall, at the Biocon Group level, net debt is at 1.1 billion. Now coming to the BBL performance in a region-wise manner. North America is now beginning to gain momentum and show resiliency in a dynamic market in the immediate quarter post the integration of the acquired biosimilars business in North America. Fulphila, our biosimilars pegfilgrastim, demonstrated continued strength with 18% market share in November, while Ogivri, our biosimilar trastuzumab, has been resilient with a market share of 12%. Reported market share of our biosimilar insulin glargine was 12%, but I must mention that these numbers do not capture the uptick of our unbranded glargine through a closed-door pharmacy network, as they are not captured as a part of public reporting. New contract wins during the quarter included 3 contracts for Fulphila, including a sole-sourced contract with a large GPO, and 3 contracts for Ogivri, including a large GPO arrangement. We also secured 2 contracts for our unbranded biosimilar adalimumab, commencing in February 2024. As you know, adalimumab has not delivered to the biosimilar promise, and the entire industry has been impacted. And of course, Biocon Biologics has also been significantly impacted by the unanticipated, market dynamics that played out post the expiry of the patent. Now coming to Europe and JANS, we have made steady gains in Europe. The market share for Fulphila has grown to 8% against 5% last year, and our biosimilar bevacizumab under a brand name Abevmy has grown to 6% compared to 1% the previous year. In Japan, we partnered with Sandoz, granting it exclusive rights to promote, sell, and distribute adalimumab for biosimilar adalimumab for subcutaneous injection. We have also granted Sandoz exclusive rights to promote, sell, and distribute our biosimilar trastuzumab and bevacizumab in Australia. Now coming to emerging markets, the business highlights of this quarter was the launch of Abevmy, our biosimilar bevacizumab in Brazil, which represents over $175 million of originator sales. With this, we initiated our direct-to-market journey in Brazil. We're already seeing positive traction for Abevmy despite multiple market players in the country. We also ensured business continuity in both partner and self-led markets. These included 6 launches during the quarter. We also obtained 10 approvals for key biosimilars across emerging markets. At the same time, we pursued new growth avenues by winning several tenders for our products, including for the acquired business territories such as Tunisia, Libya, and Ukraine. Coming to generics. At 703 crores, the generics business delivered 4% sequential revenue growth that was led by higher API sales. We received our first generic formulations approval in China for mycophenolate sodium, an immunosuppressant, paving the way for our finished dosage foray in this very strategic market. We recently received a tentative approval for anti-cancer dasatinib tablets from US FDA. TGA Australia completed an inspection of our API facility in Visakhapatnam with no critical observations. Post-completion of process validation at our Greenfield Immunosuppressants facility in Visakhapatnam, the site obtained the Certification of Suitability, or CEP, from the European Directorate for the Quality of Medicines, EDQM. We expect the Visakhapatnam site to be inspected and qualified by other regulatory authorities during the coming fiscal. This will enable commercialization of our products across all geographies. Process validation at our large volumes peptide facility in Bengaluru was also successfully completed during the quarter. Coming to research services, as many of you have already heard at Syngene's briefing, Syngene reported a 9% year-on-year growth in revenue at rupees 854 crores on the back of good performance by its dedicated centers, development, and manufacturing divisions. Though demand in discovery services was impacted during the quarter by headwinds in the US biotech segment, Syngene is beginning to see early signs of funding levels stabilizing and expect the business to start growing again. Our business model at Syngene remains resilient, and we continue to invest in scientific capabilities and important enterprise projects as industry fundamentals for pharma outsourcing remain very positive for medium to the long term. Finally, coming to novels, Bicara Therapeutics, which is developing an innovative bifunctional antibody, closed a $165 million Series C financing round in December 2023, led by TPG and Braidwell. With this, Bicara has thus far raised $355 million to date from a syndicate of biotech investors, with all Series B investors participating in this round of financing. I would like to once again remind you that Bicara Therapeutics was spun out from Biocon as a novel biotech company in the US with a view to developing this very interesting asset, first in the US and of course for global markets. And the plan was to raise venture funding from US markets, which has very successfully delivered thanks to the promise of this molecule. Now, coming to outlook. Overall, we made steady progress in the quarter towards strengthening the foundation for a sustainable growth across all our business segments. Biocon Biologics, as I mentioned earlier, completed the transition and integration of the acquired biosimilars business, and the sustained momentum for its product portfolio across markets that we serve augurs very well, and it now focuses on improving market penetration of its commercial products, launching new molecules, reducing debt, and crossing the regulatory approvals when it comes to US FDA. The generics business is making progress on expanding its portfolio and geographic reach, as well as strengthening its manufacturing base, both for today and for future growth. And as for Syngene, it continues to perform well, driven by development and manufacturing services, and the demand environment in the US biotech segment is expected to recover over the next few quarters as the funding environment normalizes. Overall, I think we've had a very reassuring quarter, a quarter that has seen the pay down of the debt by $200 million, a quarter that has seen significant improvement in market share across all geographies for our biosimilars and other products, as well as the focus on ensuring that we keep our business resilient and sustainable. The asset sale has also, contributed to the health of the business, and I do hope that as we move into the future, that this business is going to deliver on its very, very hefty promise based on our collective effort to ensure that we keep focused, drive the synergies between the businesses, and ensure that we continue to be a leader in all that we have chosen to be in terms of our chosen sectors. Thank you.